Welcome to This Explainer. Today, we're putting on our data detective hats. We're going to dig into a massive, frankly fascinating data set compiled by the Deutsche Bank Research Institute, covering over 200 years of financial history across 56 different economies. The goal here? To uncover the actual, mathematically proven secrets of long-term wealth. We're cutting right through the daily market noise, the chaotic news cycles, and all that panic, just to see what the data actually says about growing your money.
Here's our game plan for today. We're going to cover 2 centuries of returns, the macro engines of wealth, the ultimate return predictor, stocks versus bonds, and finally, reassessing investing risk. Let's get right into it. All right, Section 1, 2 centuries of returns. We're looking at a truly massive timeline here. Look, we all know the daily market panic can be completely overwhelming, right? When stocks are just swinging wildly all over the place, human nature kicks in. You might actually start wondering, hey, isn't holding cash just the safest way to protect my hard-earned money? Like literally stuffing it under the mattress to guarantee you don't lose it? Well, the data has a very definitive answer for us. -2%. Yep, looking at the global median over the last 200 years, holding cash is basically a guaranteed way to bleed your wealth. Thanks to inflation, that cash sitting under your mattress loses its purchasing power by an average of -2% every single year. So in a fiat currency world, cash is absolutely not a risk-free asset. It's actually an asset that is guaranteed to slowly evaporate. And this right here brilliantly illustrates that whole illusion of cash. Over a 200-year median, while cash just sits there at -2%, government bonds have actually delivered a positive 2.6%, and stocks, they stand tall at 4.9% annually above inflation. History unambiguously rewards people who take calculated risks and let their dividends and coupons compound. If you want to build wealth, you literally have to get your money out from under that mattress. Moving right along to Section 2, the macro engines of wealth. What is actually driving these returns?
Well, the primary engine is nominal GDP. Simply put, this is the blend of real economic output plus inflation. It's the absolute long-term anchor of asset class returns. It drives everything. Corporate earnings, household incomes, government revenues. Over the long run, asset prices are basically just claims on this nominal GDP. So if nominal GDP is growing robustly, your investment returns are probably going to be fantastic. If it stagnates, well, returns are going to struggle.
But here's where we run into a pretty serious modern headwind. 32. Out of the 56 economies studied in this massive data set, a staggering 32 are projected to see their working age populations actually shrink by the year 2050. Demographics act as a sort of economic destiny, A shrinking workforce puts immense downward pressure on real GDP growth, which obviously challenges future asset returns. Unless AI sparks some massive productivity boom, this demographic shift is absolutely a critical factor we have to navigate.
Okay, Section 3, the ultimate return predictor. How do we start tilting the odds of retiring early in our favor? To figure this out, researchers at Deutsche Bank went ahead and tested a massive laundry list of standard economic indicators. They looked at GDP growth, inflation rates, government debt levels, and interest rates across all 56 economies just to see which metric offered the absolute most reliable glimpse into a 25-year future. They basically correlated all these variables against subsequent long-term returns to see what actually stuck.
And you know what? The data emphatically points to one surprisingly simple answer: starting valuations. So the really crucial point here is that how expensive a market is when you first buy into it, that is the single most powerful predictor of your future long-term returns. It literally dwarfs almost everything else. While you obviously can't predict next week's news cycle, starting valuations actually give you a remarkably clear lens into the next 2 decades.
Now, the best way to measure this is through the CAPE ratio, or the cyclically adjusted PE ratio. To translate the financial jargon for a second, this metric basically just compares a stock market's current price to its 10-year track record of inflation-adjusted earnings. It smooths out those weird one-off anomaly years and tells us straight up how expensive a market is right now relative to the actual reliable money it generates. And here's the cold, hard proof. Over the last 70 years, if you continually invested in a portfolio of economies with low, below-median PE ratios, you would have generated an incredible 20.2% annual return in US dollars. But if you bought into the high, expensive PE markets, you got 11.4%. That's still good, but buying into cheaper markets nearly doubled the annual returns. So yeah, valuations matter enormously. All right, let's move to Section 4, stocks versus bonds. it's time to look at this age-old rivalry and see where you should actually put your capital. Now, you might actually be a bit surprised to learn this, but across this entire 200-year global data set, there's a 22% probability that bonds will actually beat stocks over a 25-year period. Crazy, right? Think about that for a second. In roughly 1 out of every 5 quarter-century periods, the quote-unquote safe asset outperformed the risky one. Bonds aren't just dead weight in a portfolio. They have a very real historical track record of winning out over massive timelines, especially if stock valuations were just way too high at the starting line. So why don't we hear about this more often? Well, it's mostly because of what we can call the U.S. anomaly. In the United States, stocks have actually never lost to bonds over a rolling 25-year period in recorded history. Never. But the U.S. is the exception here, not the rule. The global reality is quite different. In Italy, for example, bonds have beaten stocks 52% of the time since 1881. Taking a step back for a global view proves that bonds are absolutely critical diversifiers, especially when individual countries go through prolonged economic or political instability. Okay, let's head into our final section, Section 5, Reassessing Investing Risk. We're changing the definition here based on what we've learned. If you look at a relatively short 5-year window, stocks are undeniably volatile. Across the global dataset, there is a 13.6% chance of losing nominal value over a 5-year period. Over a decade, that's about 6.3%. And honestly, this short-term volatility is exactly why the daily news feels so terrifying sometimes. When your time horizon is short, the risk of taking a loss is very, very real. But watch what happens when we zoom out. Over a 25-year window, the probability of stocks underperforming that zero-return cash stuffed under your mattress plummets to a microscopic 0.8%. And get this, nearly all of those rare instances were tied to extreme historical anomalies, like the mid-19th century or severe localized crashes. Basically, when you give equities time to run, the historical risk of total loss effectively approaches zero. But obviously, holding a pure all-equity portfolio requires an absolute stomach of steel, because those severe multi-year drawdowns can and definitely do happen. And this is exactly where the classic 60-40 portfolio, 60% stocks, 40% bonds, really shines. By pairing the sheer growth engine of stocks with the balanced stability of bonds, you get historically superior risk-adjusted returns. The bonds essentially provide a buffer. They smooth out the bumpy ride so you don't panic and sell at the exact wrong moment. So just how resilient is it? Well, according to the data, a 60-40 portfolio carries a mere 0.1% chance of negative nominal returns over a 25-year period. That is literally lower than holding short-term bills. For investors who are focused on minimizing their nominal loss risk over the long haul without sacrificing too much growth, this split has historically been practically bulletproof. Which actually brings us to this defining quote straight from the research. History shows that investors have been consistently rewarded for taking risk and compounding the dividends and coupons available in equities and bonds. This brilliantly sums up the core philosophy of wealth generation. It's not about guessing next week's Fed rate or trying to time some wild headline. It's about harnessing the math of compounding over decades. We've definitely seen that buying at lower starting valuations gives you a massive edge. But ultimately, time in the market beats timing the market. The duration of your investment is far and away your greatest ally. Think of the macro engines of nominal GDP and inflation like massive cargo ships. They move slowly for sure, but if you tie your wealth to them, they're absolutely going to pull you forward. So I want to end this explainer with a question for you to chew on. With over 2 centuries of hard evidence right at your fingertips, proving that cash loses value, that stocks compound wealth, and that short-term volatility vanishes over the long run, are you going to let today's chaotic headlines distract you from your next 25 years of wealth? The data has spoken loud and clear. The true test right now is whether you have the patience and the discipline to let it work for you. Thanks for hanging out with me on this explainer, and I'll catch you next time.